The global stock market rally, which resembles the bull run between 2003 and 2007, will end as government spending slows after so-called easy money boosted asset prices, according to Morgan Stanley. Bloomberg quoted Ruchir Sharma, who oversees $25 billion in emerging market stocks at Morgan Stanley, as saying in an interview that such echo rallies are never as big as the original one and we will see it fading away. He adds that the rally will end as the effects of the stimulus begin to fade and the credit bubble caused by easy money disappears. A new rally globally needs to be driven by new industry groups, he added, while the current advance is led by the same sectors such as commodities as the ones in the bull market that ended in 2007. That is not a good sign, he said. Sharma said commodity-producing nations will be the hardest hit when the current rally ends. The Latin American markets of Brazil and Chile are the most expensive, he said, and Morgan Stanley is also underweight on Taiwan, Malaysia, Israel and Russia. Commodity prices are rising even as economic fundamentals are deteriorating, he added, a sign that the rally may be fizzling. Commodities are at the center of this echo bubble, he said, adding that they are in substantially overvalued territory way above fundamentals. Sharma said that the greatest degree of irrationality is in commodities. Morgan Stanley owns a lower percentage of commodity stocks, including metals, materials, energy and industrials, compared with the benchmark index. It holds a high percentage of financial and consumer stocks, including automobiles, retailers and beer companies. However, some brokerages are predicting further gains in equities. The emerging markets benchmark stock index may retest its life high by next year, helped by economic growth and gains in credit markets, according to JP Morgan Chase & Co. The optimism is shared by Mark Mobius, who oversees about $25 billion as executive chairman of Templeton Asset Management Limited. The investor said this month he expects developing nations shares to surpass previous records, predicting a continued rally with corrections along the way. Morgan Stanley is overweight on India, Indonesia, Poland, Czech Republic, Turkey and Thailand, as it is betting on economies that are driven by domestic demand. India, Indonesia and Czech are among the few countries that will end the year with earnings per share growth at all-time highs, while countries like Russia and Taiwan will see corporate profits climbing back to their peaks in 2012, Sharma said. Some markets may be hurt by the diversification of government stimulus away from the economy and into stocks and other investments. Central banks globally were hoping the funds will result in an increase in credit growth, driving the economy. That remains weak in most countries, Sharma said.